raises. All right, so learning objective 3 introduces you to responsibility accounting and um, the difference between cost and profit center is very important to sort of understand. But basically speaking, you have managers who have the authority to run various departments. Um, and one way that managers are evaluated is by using the accounting, using the budgets as a way to evaluate how managers are doing. Also to sort of understand that managers, there are lower level managers, middle managers, and upper level managers. And all of those managers have various levels of responsibility when it comes to monitoring the revenues and the costs that the company is going over. And so it's important that we look at this and organize it in a way that we can make it useful to help us make decisions and also to, as you'll see, to help us evaluate management. So a few things here. We use these particular reports and we sort of understand that there's certain conditions about them. One is that we can directly associate costs and revenues with very specific levels of management responsibility. So the sales manager clearly is responsible for the sales budget, right? Because that's their whole purpose, is to meet those sales goals that we have. Certain costs and revenues can be controlled by employees through how their managers are managing them and how much information they have and can be trusted with to help make decisions that help the company reach its goals. So that's very, very important. And then, of course, like I said, all of this data is used to evaluate if managers are effective in doing all of this. So again, there are various levels of responsibilities, particularly when it comes to controlling costs. And here you have an illustration, and I'm afraid it's a little cheesy illustration here, but you have department managers who are responsible for what's happening in their individual departments. You have division managers, which clearly are responsible for what's going on in a particular division of the company. And then you have the president of the company who, as they say here, the big cheese, wearing a cheese hat, right, is ultimately responsible for controlling all of it. And so responsibility accounting sort of gives that responsibility of what they can control at their level. Okay. And that's an important aspect here. One of the interesting things is, in order to actually have a responsibility report, you need to have a responsibility center, right? Who is in control of various activities, whether it's in a department or a division, and so forth. So we're going to be looking at this next. Again, any level of management can be organized this way. And it's very important that we are able to still monitor things based on these activities, because a lot of companies are highly decentralized. And so there's sort of a loose or a flat management structure where a lot of employees have various roles that includes the managerial roles and decision making that affect things. So clarifying things as to responsibility center is important, particularly in those types of companies that are pretty flat, pretty decentralized. Okay. Much of what they look at too uh, in terms of responsibility is looking at various segments of the business um, in order to help identify how things are going. All right, so a few things to know. When you're looking at costs and revenues, there are some differences that we have to know. Some things are controllable and some things are not, non-controllable. So, that's really important to distinguish because you can hold managers and employees accountable to things that are controllable. You cannot hold someone accountable for something that's not controllable. So it's really, really important to know that. And again, one of our, the most important ways to evaluate people, particularly with performance, is what's controllable. What was in their control, and they either did a great job of controlling it or they failed at controlling it. Okay. Now, this method is used to and can be applied in all entities, profit and not for profit. Okay. It doesn't really matter. So, in a for-profit business, of course, maximizing profits is a good thing to emphasize, and what can be controlled to maximize the profit is important to look at. In a not-for-profit where they're not interested in profits, but they still have to provide a lot of services, are they able to do that efficiently? Are they able to minimize the cost to the point where they're serving a lot of people, but at a minimum cost to the organization? Because that is also something that can be controlled. Okay. So one of the things to look at, again, and to keep in mind in all of this with responsibility accounting, is what's controllable at what level of responsibility. Okay. What's controllable in terms of costs or revenue at what level of responsibility. Okay. So that's important. So, of course, clearly all the costs are controllable by the top managers of an organization because clearly whatever they say is going to go. Truly, fewer costs are controllable when you get to the lower levels of management, simply because they just don't have the power to impact the entire organization, but they do have a lot of responsibility and power to control things that are part of their department or their area or their segment, right? However, we do have to make sure that we understand and can identify costs that are simply not in anybody's control, not the lower level managers, not the upper level managers. There's some things that are just beyond some folks' control. Okay. We are going to compare, as we do for all type of evaluations, and this is included by management, what the actual results are compared to what the budget results. Right. So the budget, we had these things budgeted. We were expecting this, this, and this to happen. And so that's reflected in our budget. What actually happened? Right. Those are the actual results. And then we can start understanding, okay, so which of these things that happened are within our control and which ones were uncontrollable. So part of it is understanding both part of it is a behavioral principle, part of it is just reporting principle, and that's a big part of it. A big philosophy that's used, particularly in a lot of businesses, manufacturing included, is this concept called management by exception, which means they look at the exceptions. What are the exceptions? Well, between the budgeted and actual, those are the exceptions. Right? We budgeted X, we spent X plus Y. Right. Well, why did that happen? Well, that's an exception. We weren't expecting that. That's an exception. Look into that in more detail. That's basically what management by exception is. Okay. And again, we've always mentioned here how controllable it is. how controllable it is. And then, of course, it has to mean something. So it's got to be part of that materiality. We needed the guidelines in order to investigate. There's a difference. Some behavioral principles, right, that are included in organizations is who has direct input into helping to establish budget goals. You want the managers of certain areas to be part of the process because they're ultimately going to be the ones who are going to be judged by that. So it's not fair to judge someone who had no input in the process and you didn't listen to perhaps some very, very good information that they had when you built your budget. It wouldn't be fair to directly evaluate them based on that. So managers of various responsibility centers need to be involved in establishing that. Evaluating those managers have to be based on anything that they can control. You cannot judge someone on things that they cannot control. Okay. Top management should support this entire process and how that is going to be evaluated. That's really important. Allow managers to respond in writing to their evaluation so they can talk about various things, make various points that we might not know as part of that evaluation. And all evaluations need to do two things: highlight the things that went very, very well and at expected or above expectations, and the things that went poorly, things that were below expectations. All part of it. Again, and all of these are, you're being basically judged on numbers here. So again, some of the principles regarding the reporting is the data has to be controlled by manager of the responsibility center. That's the only data that should be part of the evaluation. Really important to provide accurate and reliable budget data so you can actually measure things substantially. It's very important to highlight the differences between the budgeted goals and the actual results. That's going to be one of the more important things. Since this is going to impact various areas differently, it's somewhat going to be tailor-made to evaluate the managers of a particular area. And it should be done at a regular interval. Okay. Maybe after a large job has been done, after every quarter, what have you. But those are very, very important. So how that works is there has to be a report that's prepared for every level of the management chain, in essence. You always start at the bottom. You start with the lowest level of responsibility, and that moves upward. And you'll see a diagram on this very, very shortly. Okay. It has to allow to see the exceptions. So you have to list those differences so you can do a management by exception at each level of responsibility. And basically at every higher level, you're going to get more detailed reports for all the lower levels, as you'll see. So here we go. Here is an illustration, an organizational chart. We have at the bottom level here where we're starting, department managers, right? So you have the department manager for fabricating, for assembly, and for enamel, right, enameling. So each of these department managers would have their own budgets set. When the actual results came in, they would be evaluated on the differences, looking at the differences that were within their control versus something that was out of their control. And so, boom, that's where it starts. From there, these reports would go up to the plant manager. So here, there's different plants. So every plant would have a fabricating, assembly, and enameling department. These would go to the plant manager. In this case, this is the Chicago plant listed here. That's the next level at which these reports would go. So the Chicago plant had expectations for manufacturing and manufacturing overhead, both for all these departments, for fabricating, assembly, and enameling. Those would have to, again, the budgets would be looked at compared to the actuals. Differences would be noted, those exceptions would be noted, needed to be explained, what was in their control, what was not, and the reasons. Each of the plants would be doing the same thing. Then that would be reported up to the vice president overseeing, in this case, might be the vice president overseeing production, because you have 3 different plants here coming up to this one vice president in charge of production. So this vice president would be getting a report that would not just tell them, this person, what was happening at each of these plants, but each of the departments within those plants, all those numbers would be included so they could look at the larger picture. Okay, this is what's happening in St. Louis. This is what's happening in Chicago. This is what's happening in Detroit. And this is what's happening overall in our production. And from that report would be sent up from the vice president here of production, along with all the other vice presidents in their areas, up to the president of the company. So this person would see all of the data from each of their particular vice presidents. Okay, so that's the flow of how it would go. This is what the chart would look like. Again, we would start way down at the bottom here. Report D would show us specifically what the department manager would have. In this case, this is very specific to the fabrication department. Okay, so again, it would simply be, in this case, one of the departments, this fabricating department would be the one, would show this particular level of detail for their budget, showing the budgeted amounts, the actual amounts, and any difference, whether it be favorable or unfavorable. As you see, everything here shows unfavorable. In other words, all of their costs for materials, labor, and overhead were above their budgets, leading to an unfavorable report. Now, again, every department manager would have one of these, so not just for fabricating, but for assembly and for enamel and so forth and so on. Those reports would be collected and given to the plant manager in charge of the particular plant. And you saw those plants, one was in Chicago, the other was in St. Louis, and so forth and so on, right? So the plant manager for the office, in this case for the Chicago manufacturing plant, would get all the costs for all the departments. Here's the fabricating department, which is this budget, but the enameling department's budget would be here, the assembly department's budget in here, with their reports showing that in Chicago, anyway, when you looked at all these the manufacturing issues, they had an unfavorable total of 5,300, looks like. So they were over budget, right? By this amount, it looks as though, right? When it came to other types of things, it looked as though they're for the Chicago plant, that was not related to these particular departments, but perhaps indirect related stuff. They were also unfavorable. So in essence, they were all over budget. Their costs were all higher than they budgeted. That would then go up to the vice president in charge of production in this case, and all of the assembly plants would be listed for, here's the Chicago one up here, then you have the Detroit and the St. Louis plant, again, what they budgeted, what their costs were. And as you see in this case, again, for all three plants, but mostly thanks to that Chicago crowd, basically had a very large unfavorable, right? They were over budget by 7,300. And again, this was in the production department. And then that would all go up to the president. The president would get a report from for the vice presidents of sales, of production, and of finance. And you see here, all of them are are not doing so hot, right? Because their costs, actual costs were higher than their budgeted costs. So this would be something that they would be taken at the expense of their profit, because it has to come from somewhere. Okay. And hey, they had larger slides. Did anybody tell me? Yeah, I just liked it because it was all on one slide. So I kind of looked at it. But this is what the individual ones look like. Okay. So again, step by step, it starts at the lower level. So report D really is the first one from each of the particular managers within each of the plants, right? Showing direct labor, direct materials, direct labor, and overhead budget and actual, and what the whether it was favorable or unfavorable. And again, it sort of reports up, right? Plant. So this is department manager, plant manager, vice president of all the production, and then finally it goes up to the president. So this is how responsibility accounting would be done. And again, notice on all of them, by the way, they all emphasize controllable costs. They all emphasize what the managers were meant to control, but in this case, still unfavorable, but not by a tremendous amount, but still not terrible. Not great, not terrible. So in terms of when you're looking at responsibility centers, there are three main types of responsibility centers. A cost center is the most common, and that's basically a cost center for a business is a part of the business, say like customer service, which incurs costs but doesn't sell anything. So they don't generate any revenue. So that's a typical cost center. So like I said, customer service department for a large company, say takes care of customer issues, but doesn't generate any revenue. I'll tell you, for the college, the faculty might be considered a cost center because we're not directly generating revenue. We're not out there selling anything. We're busy teaching. So technically we would be a cost center as well. So managers have authority to incur the cost, means they can make costs happen. They have the authority to spend a certain amount of money that the company has budgeted to get the job done. They're evaluated on how good they are at controlling all of that. Are they able to get the job done at less cost or at more cost? Okay. So again, usually it's either a production department or some type of service department within a business. There's your cost centers. If you work for a cost center as well, you probably are not going to be getting like wonderfully big raises because they're trying to hold that down. You are basically an expense. You are not generating revenue. You're an expense. So they hold that down. Our friends in a profit center don't have that issue. Profit centers are directly related to generating revenues. They certainly do incur costs because you need to pay salespeople, you need to put out marketing and other types of things, but that leads to them directly generating revenue for their company. Profit center managers are judged on, did they make the sales, or did they go higher? How profitable was it? And so that's really important to sort of know. If you work for a profit center, you're probably going to get much, if not higher raises, you're going to get a lot of incentives. So if you sell more than your quota, there's a bonus for you. But if you sell even more than that, is a bigger bonus, right? They're willing to pay you more if if you can generate more revenue for them. Why? Because it puts them above their budgeted sales numbers, and so they're willing to share that with that. So folks that work in profit centers tend to do quite well, because it's directly related to generating revenue. And once the company reaches its goals, it's very happy to share that revenue if it goes beyond that. And then we'll be looking at something called an investment center. An investment center is a little bit different than a profit and cost center, although technically it does incur costs like a cost center. It does generate revenue like a profit center. However, their main focus is looking for various investment opportunities for the company to grow. And so they're evaluated not just on their profitability, but at the rate of return that's going to be earned. So we're going to be learning a lot about that in Learning Objective 4. That's going to be the next big thing we're going to be looking at. And so again, what can managers control? Quite a lot. What do they influence? Well, the expansion of the business for the most part. So plant expansion, buying various things, has to have a return, but they can control quite a bit. So again, the types of responsibility centers, cost centers really are generally just expenses for businesses. They don't generate any revenue. Profit centers, yes, they do incur costs, but they are the way in which revenue is driven for the company. And then you have an investment center, which does all of that, but provides, in essence, a return on investment that the other two centers don't. Okay. All right, so the responsibility accounting that's done for a cost center is really about the manager's ability to make sure that they're controlling costs. I mean, it's pretty simple. This is the budget for this particular area. Do your best to control it. Don't go over it. Right? So that's really important to sort of understand. Here we have a responsibility report for the finishing department. The finishing department is a cost center at Fox Company. Here you have their budgeted amounts for indirect material, indirect labor, utility, and supervision. These are the actual amounts that were spent in the month of January, showing that they budgeted to spend $40,000. Clearly, they spent only $39,600. That's $400 less than they expected, so that's a favorable outcome. Their costs were lower than expected. That's favorable, and so this would reflect good on the manager, particularly in the area that gave them the biggest benefit, which is indirect. They saved a lot more money in indirect labor creating that. So this report would be assuming that the finishing department manager can control all of the costs. The only exception to that would be the fixed costs that were provided, such as depreciation, property taxes, and his or her own salary for the month. But the other amount, so there was $10,000 budgeted for that, but the other amount outside of his supervision can be applied to other personnel whose salaries can be controlled by the manager. And so they're going to be judged a lot more on how this was used versus they have no control over the fact that that's a fixed cost for them. So for a profit center, again, they have both expenses and and revenue. So what can they control is how they're going to be judged. Again, because revenues are so important, that sales and sales budget is so important to a business that this is going to be a really large way in which the manager is going to be evaluated in this case. And again, it assumes that the manager is able to control the variable costs. Okay, can't control some fixed costs, but so there are what we call direct and indirect fixed costs. So direct fixed costs here they're specific to one particular area. They benefit the center, that particular responsibility center alone. They can be traced to one particular center, and they are controllable by the profit center manager. So here's a little bit more on that. The indirect fixed costs really represent the overall operating activities of the company. Indirect fixed costs benefit more than one profit center. Indirect fixed costs are also considered common costs because they do apply to more than one center, and they're not controllable by the manager of the profit center because it affects more than one. It's not controllable by one person. So the responsibility report would show the budgeted and actual revenue and costs that are controllable. Controllable revenue, controllable costs. You can use the cost volume profit income statement format to show how controllable fixed costs were deducted from the contribution margin. The controllable margin this is a great word, controllable margin here. It's the excess contribution margin over the controllable fixed costs. Okay. Non-controllable fixed costs are not part of this report. Controllable margin. Again, the word controllable means that it's going to be part of someone's responsibility. So here is the responsibility report for the marine division for Mantle Company. And here is the budgeted line here showing sales of budgeted of 1.2 million. They have variable costs of cost of goods sold, selling and administrative expenses. Contribution margin is listed here. Then they list what's called controllable fixed costs, and they take the difference between the contribution margin and the total controllable fixed costs to get something called controllable margin, right, which they can link back to the manager of the department. The actual numbers are provided in the second column here, showing that they failed to meet their budgeted sales. So that automatically put them in a $50,000 hole of unfavorable differences because they were unable to meet such a high level of sales that they had. Even though the variable costs all came in favorable, okay, they spent less on cost of goods sold and selling administrative costs, so their total variable costs were less than what they had budgeted. However, when you compare that to the fact that they missed their sales by such a large amount, you still had a contribution margin that was below the expectation by $36,000. Their controllable fixed costs, budgeted and actual, are matched perfectly. So what you've got is a controllable margin where they basically had an unfavorable result of 36,000. So this basically was their their unfavorable result, but it was controllable. So they're going to go back and particularly look at the sales difference. That's a large gap. So what went wrong is one of the questions that has to be asked, right? We clearly know that a few things went right for their variable costs because they had favorable. But clearly, this is the biggest problem, caused the big difference. So this report does not show on what's called non-controllable fixed costs of 60,000 because it's not controllable. And responsibility reports are really all about what managers can control. Okay. So here's our do it exercise. Again, lots of new terms, lots of things to sort of understand how these work in terms of evaluation of managers, but clearly not a lot of accounting to do per se, just a little bit. And you've already done these favorable, unfavorable things before. So this should not be a big problem. Midwest Division operates a profit center. So there operates as a profit center, right? And they report the following for the year. So here they have they have their budgeted amounts listed here for sales, variable costs, controllable fixed costs, and non-controllable. And their actuals were provided here. Okay. So prepare a responsibility report for this profit center. Okay. Well, budgeted sales were 1.5, actual 1.7. Clearly, they did much better than they expected. So you're going to have a favorable $200,000 difference here. Their variable costs were a little bit over budget, but that's okay. They sold a lot more, but they had an unfavorable line for variable costs. And so their contribution margin is actually the difference there. It's 100,000 favorable because they had budgeted for an $800,000 contribution margin. They actually got a 900,000. That's 100,000 more. That's why it's favorable. Controllable fixed costs are equal, leading for a controllable margin that's 500,000 higher, which means we had $100,000 in favorable difference between budget and actual here. Okay, again, not a ton to do there, but enough. So I'm going to wrap up chapter 10 with learning objective 4 here. So let's forge ahead. This is going to be focused on that investment center reports because our investment centers, they do incur costs, they do produce revenue, but probably the most important thing that they do is they have a basis to make investments for the company. And again, invest for the company mean buying assets, right? So ROI, return on investment, is the primary basis in which managers are evaluated in an investment center. Okay, so it shows the effectiveness in management decisions, and oftentimes almost all the factors are controllable. You know, so the manager, it's a good way to do it. So what do we have for return on investment? We take the controllable margin and divide it over your average operating assets. So average operating assets, beginning and ending operating assets divided by 2, right? So in this case, we had $1 million controllable margin over $5 million of average operating assets. So the return on investment here in this example is 20%, which is fantastic. You know. So again, what are we looking at? A couple of things. Define operating assets as current assets and plant assets used in operation by the center. Okay, so that's your operating asset definition. You want to base your average operating assets based on the beginning and ending book value of the assets. Okay, so that's how you would get that. So This particular responsibility report for an investment centers are looked at as somewhat independent entities for operating purposes. They're such a different animal here. And another thing about investment centers is their fixed costs are considered controllable by the manager of the investment center. Okay, so we look at two things. Managers create budgeted ROI and compare to actual ROI. So let's take a look at an example here. So this is Mantle Company Responsibility Report. It's the same report as what we saw earlier. However, now we're going to be looking at it from a return on investment perspective. Okay. So when you look at the budgeted amount, when they went ahead and did this, they were expecting a controllable margin of $300,000. Okay, that was their controllable margin. They had average operating assets of 2 million. That information is given to us here. Okay. So when you take the $300,000 in controllable margin and divide by the 2 million in average operating assets, you get that 15% ROI. Okay, that's what was budgeted. But what actually happened was, as you know, they missed their sales target, leading to a smaller controllable margin, 264. When they put that over $2 million, their ROI was only 13.2%. Now, 13.2% is still nothing to sneeze at, but it's not 15%. So their actual ROI was unfavorable, right? Below 1.8% below where they thought it was going to be. Okay. That $36,000 difference divided by the $2 million of average. So this is something you're going to have to do to understand that. Okay. So again, there are some judgmental factors here. Probably one of the more important ones is, the valuation of the operating assets. Again, whether we use the same one, but most of the time it's book value. But you can use acquisition cost, book value, appraised value, or fair value. All of them are a reliable basis for evaluating this. And in terms of your margin, again, as you notice here, we are using controllable margin as a way, not contribution margin, controllable margin as a way to calculate our return on investment. Okay. So in most cases, again, controllable margin is used. You can also use net income or income profit from operations. However, if you're only going to look at an investment center manager, you can only use controllable margin to evaluate. So how do you improve ROI? Well, you can do it in a couple of ways, clearly, right? You can improve it by making your controllable margin larger, right? You can also improve ROI by keeping your operating assets lower. So that would also help. One of these, either higher controllable margin or a lower average operating asset would create and improve your return on investment. You would know that. So here's the illustration provided in the book for their laser division. Controllable margin was $600,000. Their average operating assets were $5 million. So the return was 12%, 600,000 divided by the 5 million. Right? Well, what if a few things changed? What if we had higher sales? Right. What if sales were increased by 10%? Again, you got to go back here. Again, we were looking at $2 million of sales. What if they were 10% higher? So that means your sales would be 2.2 million, right? Which means your contribution margin increases by 90 grand, and thus your controllable margin increases by 90 grand. So that means your controllable margin is 690 over the say $5 million in assets. And look at that new RORA. It went from 12% to 13.8% based on increasing your sales by 10%. Well, what if you reduced your costs by 10%? Variable and fixed costs have decreased by 10%. Oops, sorry. Are you all still able to see the PowerPoint slideshow? I just got a little message on my screen, sorry. So here we have, if you decrease costs by 10%, they would go down by 140,000. Okay. That would create a controllable margin of 740,000, would be substantially higher. So now your REI would increase to 14.8%. That's significantly higher. Okay. So again, one way increase sales, another way decrease your costs. Both would lead to higher return on investment. What if we assume in this case that our average operating assets are 10% lower, or reduced by 10%? So instead of 5 million, they're 4.5 million. Everything else would stay the same in terms of our traditional controllable margin. So we would have our REI increase 13.3%. So these are going to be some of the questions that they're going to be asking you to figure out here for this part. And again, this is probably going to, it's not that bad, but this is probably going to take you a little bit of time to work through these numbers as these things change. So here's your do it exercise to end today. We have our service division of Metro Industries report the following results. Sales are 400,000, variable costs 320, controllable fixed costs at 40,800, average operating assets of 280. Management is considering the following independent courses of action. So you're going to figure out each one separately. The first thing they are considering is, what if they reduce average operating assets by 80,000? No change in the controllable margin. And two, what if they increase sales by 80,000 with no change in others? So these are the things we're going to have to compute. Compute the controllable margin for 2017, and then compute the controllable margin and expected return on investment. So let's take a look. Our first thing we would do here for 2017, we had sales of 400, variable costs of 320, so our contribution margin was 80. We subtract out our controllable fixed costs to get controllable margin of 39,200. We put that over our average operating assets of 280, and we would come up with a 14% return on investment, which is good. Again, double digits is where you want to be. Okay. So here we're going to compute if there's some differences. Alternative 1 and alternative 2. So alternative 1 meant that we reduce the amount of our average operating assets by 80,000. And if we did that, the average operating assets would only be 200,000. And so we would have a whopping REI of 19.6%, which is outstanding. The other option we would have is to increase sales, right? If we increase sales, our new controllable margin would be $55,200, and over our traditional $280,000 of average operating assets, we would have return on investment of 19.7, just slightly better. But I think be happy with either one, frankly. Okay, so that's basically how chapter 10, yes, chapter 10, wraps up. Again, learning objective 3, understanding responsibility accounting, and how that flows up and who's in control of what, right? Learning objective 4, understanding return on investment. Very, very important. Okay. How are you feeling?